Negative gearing is basically you are taking losses on the property and claim it against your taxes with an anticipation or hope that your property growth is going to outweigh the losses that you're going to make on your property. Basically, that's what negative gearing is. So if I'm making, say, $10,000 in losses in the property, and when I say losses, I'm talking about holding costs. So your interest rates are higher, your rents are lower, or your holding costs and rents, the difference between the two is negative. What you're doing is you're using that to offset it against your PAYG income, your normal income. And you might get 30 cents on a dollar back. So instead of you losing $10,000, you might lose, $7,000, because you're getting 30 cents on it. So you're still losing some money every year, but that $7,000 loss every year for a period of, say, 5 years, and you have lost, say, $35,000, $40,000, you would expect, fingers crossed, that your property grows by 6 or 7 or 8% or 10% every year, and that outweighs the losses that you're making.
You're listening to Help Me Buy Property podcast, powered by Investor Partner Group. We help improve lifestyles by building scalable and sustainable generational wealth and passive income streams. We do this via our ecosystem that is a one-stop shop to all property investment needs, from evidence-based, data-driven buyers agency, industry-renowned portfolio reviews and property strategies, property development with and for clients, tax, SMSF, business structures advisory, and cash flow real estate. Everything we do is to help people achieve financial independence and not just basic financial freedom by using property as a tool and as a medium. Presently, we've launched Australian Property Academy, where we are training and teaching buyers agents, property advisors, property strategic partners, and secrets to finding investor-grade properties to astute investors. Connect now to experience it yourself, or drop in a line below at info@helpmebuy.com.au to get more information. Be kind and happy investing.
Today, we are going to discuss the future of Australian property real estate market. We are going to talk about the new changes that are being proposed in relation to negative gearing, capital gains tax, and the impacts of these changes. We are going to also talk about the outlooks for interest rate changes and interest rate drops that everyone keeps talking about. And we're going to also discuss what does that really mean in the real sense when it comes to real estate market. In order to talk about all of these, let me bring my co-host today, Miss Cheryl, on the podcast. Miss Cheryl, how are you today?
G'day, Moss. How are we doing? These are some really topical ones, and I think it's really important that they're so meaty, right? The negative gearing one, as we know, it brings up a lot of emotion for a lot of people, because that was what we were sold on.
Definitely.
Many, many years ago, around the beauty of negative gearing. And there's a place for negative gearing. We're not poo-pooing
100%.
it entirely. I think if we start off with negative gearing, let's give everyone a bit of a high-level summary of what negative gearing is to begin with. I guess the pros and the cons, and then let's talk about what are some of these changes that are going to be happening. Definitely. And what the impacts are.
Yeah, it's a very good idea. And so I agree. When you talk about real estate market, everyone talks about negative gearing, and has been the talk of the town since forever, since I was little, since I first came to Australia, I think. Everyone used to talk about negative gearing and property in the same sentence. What is negative gearing? Negative gearing is basically you are taking losses on the property and claim it against your taxes with an anticipation or hope that your property growth is going to outweigh the losses that you're going to make on your property. Basically, that's what negative gearing is. So if I'm making, say, $10,000 in losses in the property, and when I say losses, I'm talking about holding costs. So your interest rates are higher, your rents are lower, or your holding costs and rents, the difference between the two is negative. What you're doing is you're using that to offset it against your PAYG income, your normal income. And you might get 30 cents on a dollar back. So instead of you losing $10,000, you might lose $7,000, because you're getting 30 cents on it. So you're still losing some money every year, but that $7,000 loss every year for a period of, say, 5 years, and you have lost, say, $35,000, $40,000, you would expect, fingers crossed, that your property grows by 6 or 7 or 8% or 10% every year, and that outweighs the losses that you're making in the property market. It's typically what negative gearing is.
So when negative gearing was really sold, and I guess to a certain extent it's also sold where, particularly with higher income owners, where they might not have anything else that's offsetting the amount of tax that they're paying, right? So often if you're earning, say you're earning about 200 grand and you've got a fair chunk of that that's going to tax, you're like, how can I be more tax effective? Because close to half of it is going to the ATO. And so that's where often, whether it's accountants or so on, so go, okay, well, why don't you go invest in some property? And I guess that's where the whole idea of buying a negative geared property was be able to leverage the tax that you would have paid to help put towards a property which was negatively geared. And so, the best case scenario now is that you are almost sort of neutral in terms of cash flow, but a lot of negative gearing was actually around losing money, like you said, Moxin. I think when you're losing money at the end of the day, where does that money have to come out of?
It comes out of your disposable
income. It's got to come out of
And I think a lot of people also considered, depreciation benefits. And so depreciation, a lot of property spookers out there will always talk about, hey, look at this, you have an extra $10,000 worth of depreciation. That is not a real cost to you and it's not going out of your pocket, but hey, you can claim 30 cents on a dollar on this 10,000 depreciation as well.
That's right.
I always say that depreciation is a very temporary benefit. It's not a permanent benefit. It's a cash flow impact to you right now where you're getting cash flow back. But whenever you decide to sell, this depreciation gets added back into the property when you're selling the property. Okay. So it's not a real benefit per se. And so any decisions, especially in the negative gearing space, if you're making by taking depreciation into account, you need to know that this depreciation would need to be paid back to the tax office. And we've talked about this in our previous episodes where it reduces the base price down. And so any depreciation, say 50,000 that you've claimed over 10 years or 5 years, it would be added back when you're planning to sell the property.
Yeah.
So it's not a real comparison, when you're looking at negative gearing benefits.
Yeah. And so I guess this is where probably from a regulatory point of view, they've proposed these changes. So let's talk about what are these changes that they're suggesting here.
And look, the Greenies and the Labour government have been talking about these changes for years and years and years, right? And one of the reasons that these changes are always proposed is that government tends to lose a lot of money in tax collections because of these negative gearing benefits, right? A lot of people do own, more than, 1 to 2 properties, or investor is a big pool, right? There is about, 30 to 40% investors out there who actively play in this space, right? So what the government typically wants is they want this money coming back. And especially now that the interest rates are high, the government is bleeding money, there's a big budget deficit, they want to bring this money back into the economy. It's a very two-edged sword, and we'll talk about the changes. It's a very two-edged sword because on average, every politician owns more than 3 properties, which is why would a person vote against negative gearing when they have 3 properties, which are, and all of these properties are in Canberra or Sydney, right? They're not in a whoop town in Perth or a whoop town in Queensland, right? They're all premium real estate that they're holding, which are significantly negatively geared. So it's always like, you voting against your own personal property portfolio when you're asking politicians to vote against negative gearing. And that's why they've never been able to put legs against it. Every time they've gone out for vote, they've always lost. It seems that, that could be the case this time around as well. But there is a lot of talk and discussions around this. So let's talk about some of these changes that they're proposing. There are 2 types of changes that they're proposing this time around the corner. One is in relation to negative gearing and the other one is in relation to capital gains tax. So negative gearing changes that they're proposing this time around is they are saying negative gearing should only be allowed on brand new properties. So established properties do not get the benefit of negative gearing at all. So you cannot offset it against any income. For established properties, the negative gearing allowed is only against the rental income. So you cannot claim it against, your personal income. You can still claim it against rental income for established properties. But for new properties, you can claim the negative gearing against your personal income as well. And any losses that you are capturing as part of the negative gearing, they could be transferred across number of years, and they would be claimable against the future rental income as well. So it's not that they're completely disregarding it. What they're basically trying to tap into is the established properties that are negatively geared, and they want that to basically stop against the personal income. The second important change that they are also making, and there is a further change to this. So properties that are there, which are already bought and, they've been bought before the deadline, and they would be grandfathered. And so what the grandfather basically means is that they would stay in perpetuity and you can still claim negative gearing on these properties till they change hands. And so someone else buy these properties, right?
Okay. So it's not going to affect you if you already have a negatively geared property.
Correct.
So it's not so much the people that have those properties now. It's like if you're going to be purchasing into a property.
Correct.
Don't get yourself taken on a ride by property spookers, so-called property investment advisors, or buyer's agents who are selling house and land packages or off-the-plan properties or apartments. Get yourself a copy of this book called The Millennial's Guide to Property Investing. This book is not just for millennials. The title suggests, but it's actually the most advanced way of investing in property. This book will relate to your clients, your colleagues, and other business owners. There are so many property spookers out there who have come out of the woodwork over the last 3 to 5 years, and there is so much misinformation out there that I had to write a book about all the F-ups that people can actually avoid in order to be super successful in the property investment journey. Some of these are really easy to identify, but they are so costly to fix once these mistakes are made. So it's a short book, it's easy to read, it has a lot of stories, it has a lot of examples, and it is a true guide for people who wants to do it themselves. My name is Moxin Reza. This is my story, and a lot of you will relate to parts of this story if you're not born in the riches and if you're trying to build a property portfolio that can last generations and help you improve your lifestyle along the way. So I give you a chance to come out there and have a read. Be kind, stay safe, keep smiling, keep investing, and please do check out the book.
So there are two ways to, deliver this, and you remember, capital gains tax has 1985 rule attached to it, right? Any properties before 1985 do not attract capital gains tax, right? So they could go by the year of the build, or they could go by the year of the purchase. It could go either way, right? I think, from a negative gearing perspective, it makes a lot more sense from their perspective to go by the year of purchase rather than the year of the build, because, you would miss out on a lot of properties that would still be, negatively geared if you go by the year of build, right? And what you would end up doing is you would create a two-tiered market where all the properties becomes a lot more attractive for people because they have negative gearing benefits attached to it, right? So they would never, or they should never technically go with the year of build, and they should always go with the year of purchase. There is also a second change that they're proposing together with this, which is in relation to the capital gains tax. So for viewers and listeners or astute investors, they know that if you hold a property for over 12 months, you get a 50% discount on the capital gains tax. And so if your property has gone up by $100,000, you can discount that $100,000 by $50,000 or 50%. And the capital gains tax is only paid on the balance of the 50. So what they're proposing is, again, they're proposing to reduce this discount from 50% to 25%, or halving that discount. And again, the existing properties would be grandfathered. So same rules apply. If you bought a property and if it's before the cutoff date, then, you can still claim 50% CGT on it, on these properties. But if you decide to sell it and someone has already claimed it, then the next person do not get that opportunity to do that anymore. Right.
Oh, okay.
So two major changes, it can basically move the market quite significantly.
Yeah, absolutely. So just clarifying the CGT aspect, if they're looking to reduce CGT, the CGT discount from the 50% of the growth to 25%. So they're only applying the CGT to 25% of the growth.
No, so it's the other way around. So what they're saying is, let's take this as an example. If you have $100,000 in growth, your property has gone from 500 to 600,000. Previously, you could do a 50-50 split. Now they're saying 25% is where you don't pay any capital gains tax, and 75% is where you pay capital gains tax.
Yeah, that's significant.
It's very big. That's massive.
A lot of people will not be very happy with that.
Yes, but again, there is a point of grandfathered notion there, which means that if you have a property now, and they're making a decision and they provide a cutoff, then any properties purchased after the cutoff basically goes through the new rules. Any properties purchased before the cutoff still goes through the old rules. Yeah. So,
really, we want to understand what are the impacts of these changes, right? What does this mean? Because anything to do with changes in tax and money and all that is going to really rattle a lot of people, and particularly property investors that they might have significant property portfolios or looking to build their portfolios. Let's break that down. What are the positives and the negatives? Yeah.
Look, the first and the foremost is that every time a government offers a cutoff where something good is happening on one side and the bad is happening on the other side, people who can afford the good would always jump in to basically cash on that good. We remember stamp duty changes in, ACT. And before the stamp duty change happened, you saw what the market did, right? It went bonkers because no one wanted to basically pay land tax versus stamp duty, right? So, you would see that, there would be a sudden shift in the market for people aiming to enter into it before the cutoff or before the go live date, right? So people who have been sitting on the fence, was sitting on a lot of cash, who haven't made the decision, they'll try to basically enter in as fast as possible and use as much borrowing as possible to basically, make good of the good side of the story rather than going into the bad side of the story, right? What you would also see is, there would be a higher competition in smaller markets because, buyers who were playing in bigger markets previously, sustainably, right? They would jump into smaller markets, right? You would see that change coming through because they would be like, okay, I need to maximize my returns now. And so if I can't play in the bigger market because the interest rates are high or I don't have the servicing, I'll jump into a smaller market and grab stock there because ultimately, I want to make sure that, I'm not paying any capital gains tax or I'm still getting benefits of the negative gearing, right? And so I would personally be very surprised that you would not see major shifts in major markets, but you would see major shifts in smaller markets where the typical median price would move quite quickly for people trying to push in and, jump into these areas. And government expect this, they know that the market is going to jump quite a bit. And because these are federal changes, these are not state-based changes, these impacts would be universal across all different states.
Oh, Australia, yeah.
And so while the notion from government's perspective is, we want to make life affordable and we want to make property affordable, it always backfires to the governments because that's not how investors think. They jump in to cash in on what's benefiting them now without thinking them a long-term benefit. And so they will move the median so much that, it becomes even more unaffordable for people who have been playing in the smaller markets because they're like, these people from bigger markets have come in and started playing. People playing in the leagues are now playing in our county. Basically, that's what starts ending up happening. So these are some of the major changes that you would see typically in some of these areas. The other thing to also consider is the building shortages.
Yeah, so this is where we're seeing it kick off a bit of a vicious cycle, aren't we? With it, people, you've got the first movers who are going to be triggering, and they're onto what the government's doing, so they're going to be making those first moves into, all right, well, I better get this in place now. I want to take advantage of what the good stuff that's in place now, just in case it's going to, because I can see that it's going to possibly negatively be impacted for any future purchases. And so they're going to have that first mover advantage. And there's going to be that trickle effect of people who are suffering from FOMO going, oh my goodness, now they see what's happening. They're going to want that. There's a bit of a race against time to get that in. So what does that mean? That this market pressure from an like a price perspective for properties in these sort of lower, not so much established suburbs. It's more the established suburbs, but obviously some of the lower priced properties as well. They're going to be pressured to move forward, and then it kicks off a cycle of, well, then rents are going to go up. Because there's
definitely 100%.
So then we're sort of kicking, that vicious cycle, and whether it's a vicious cycle, it's a cycle of some sort, right?
100%.
But going back to your point around providing affordable housing, I often think there's a little bit of lip service there when then you have these policies that really impact the way that investors are purchasing, that are going to really radically affect then that availability of affordable housing.
Definitely.
And affordable rentals.
And you are 100% right. When you talk about, post changes impacts, the building shortages that are already there and worsens in established areas where there is not new builds coming in areas anyway, and people would not be interested in established properties, so there are not new builds coming in and people are not buying established properties. What does it do? It basically pushes the demand up, which means that the rents would go up, which means that the established properties in established areas becomes more attractive to people, and they push the price even more further up, right, to basically attract. And so every time the yield goes up, it's an incentive for the investor to enter into the market, right? So it's a continuous sort of spiral of rents going up, prices falling, rents going up, prices falling, and where does that stop? It would be quite interesting. Like the post-implementation impacts would be even more detrimental than the pre-implementation impacts. So, and And with interest rate cuts on the horizon, like people would bite into this and they'll say, oh, I'll manage my risks and with an anticipation that the rates are going to go down. And so I might acquire, a land banking opportunity now and acquire some of these properties now with an anticipation. And so, do you know what I mean? Like people would absorb these risks right now because they know that the rates are going to come down and eventually they'll be okay.
Yes.
And so people who've been sitting on the fence who don't want to take that risk, this is a final push for them to basically go out there and acquire a property, right? And push the market even further, right? And that's what RBA was alluding to, when you hear them talk about the rate rises and, why they didn't do the cut, right? And why didn't they follow US market, right? So it's basically some of these issues because they know that they can send the property market into a spiral high, right?
Yeah.
The high that they've never seen before.
Yeah.
By just signaling a rate cut at this given point in time because of all of what government is doing.
And so in terms of action, those that are listening to this episode and are starting to get a little bit nervous, I guess it's good to understand what are some of the actions or just be aware of and prepare yourself. What are some actionable things that we can start to put in place to prepare for this?
Look, the most important thing is that some of these decisions, when the government makes them, the impact starts coming through right there and then.
Yeah.
And so sometimes if you're sitting on the fence, it makes a lot more sense to take yourself out of paralysis analysis and go into decision-making zone. Either sit on the fence, you don't sit on the fence, either make a decision, go ahead and make a decision or don't make a decision, right? Because you will feel quite miserable and you will feel quite, should I say, frustrated by missing out another opportunity, right? So, make up that mind as to, okay, you're consciously making up that mind as to whether you're going ahead or you're not going ahead. As I said, every time a decision gets the response pretty much right away. So people will not wait for the cutoff. Usually these cutoffs are 1 year later. So the government might announce something now and they'll say June 2025 is the cutoff and 1st of July is when, it basically comes into play. So during that time, the market starts taking off quite aggressively in smaller markets. And so you would see those lead indicators coming through as well, right?
Yeah.
And we'll talk some of this in our next episode about interest rate and, how does that flow into this conversation as well and what are the lead indicators that we are seeing. But from an investor's perspective, if you are ready, just get in, don't wait.
And speak to your property accountant about how these changes are going to impact you, right? Hopefully they're up to date with what these proposed changes are and can give you and can advise you on how it's going to impact your current portfolio and also your future portfolio buying, and be able to assess for you in terms of your current income and so on as to, probably do some scenario and cash flowing for you if that's what your accountant has the ability to do. Because ultimately, you want to be able to see what the impact is on your financials.
Definitely.
Now, is this going to help you get to where your financial goals are from a numbers perspective, from an accounting perspective? So,
definitely,
don't feel that you need to navigate this all by yourself, right? It's not around. We always say, surround yourself with your 18. Ultimately,
definitely.
Now that you're aware of this is happening, who are the people that you need to bring in?
Yeah.
I have a particular mantra which really helps me get over these instances where you're like overwhelmed, analysis paralysis. It's who not what. It's who not what. It's who not how. It's like, who do I need to talk to be able to understand the situation and be able to help me make the right decisions and to take the right to address this.
And these are golden words, ultimately you need to follow your own strategy. And so your strategy would dictate what your property plan or pathway needs to look like, right? But for some people, they might be acquiring a property next year and they might bring that forward, in order to respond to some of these things. But never do a knee-jerk response. That's an amazing segue. Like, never do a knee-jerk response to some of these things. There would always be things that the government were doing, and you need to ensure that you are an expert investor and not just an opportunistic investor.
Cool. Absolutely.
If you have any questions, comments in relation to the changes, please feel free to reach out. It's an interesting discussion. It's an interesting dilemma for a lot of people who have been through this. I remember seeing some of these changes in depreciations, in 2017. So government decisions always have bigger impacts on real estate market. So reach out if you need any help, assistance, support. Keep smiling, keep listening, be kind, take care, stay safe. This is Cheryl and Moss checking out. Adios.
Take care. Bye.